Joining me now, Mahoney Asset Management CEO Ken Mahoney, also joining the conversation all morning long, the Wall Street Journal senior writer John Hilsenrath, and the King's College in Manhattan professor of business and economics and Fox News contributor Brian Brenberg. Good morning, everyone. Great to see you this morning, and thank you for being here. Ken, let's start with you. Talk about what we're seeing in the markets. Obviously, we're just watching the futures today. It is a holiday here, but new records were set last week, and so many folks are wondering, is this in fact a bubble?
I don't know if it's a bubble or not. Behind its sustained earnings, I mean, the fourth quarter, which ended December 31st, you're seeing what, 90% reported. Again, you said Walmart, CVS this week kind of finished off the S&P 500, and 82%. I mean, those companies either met or beat expectations. So it's very real. You have to have earnings. Again, I feel bubbles are out there when you don't have earnings or earnings sustainability or earnings visibility, which now we have better visibility. You know, last year around this time, a lot of CEOs said, you know, we can't give you visibility. We don't know what earnings are going to be with this pandemic. And now you're starting to see some visibility. You're starting to see some of that. So, look, there are some areas, no doubt. The administration has now gone away from fossil fuels, have gone towards renewables, electric vehicles. Some of those ETFs and individual stocks are going parabolic. So, yeah, those areas there are definitely kind of bubblicious, I guess. But in the area as far as the market as a whole, I don't see that because we have low interest rates, which, again, elasticity of earnings, and we have really good earnings growth.
Well, it's interesting, and I'm just going to ask you about the earnings picture there, because there are some companies that are not giving any guidance at all. Some companies warning, in certain sectors and industries, they're going to have to furlough workers because the recovery isn't happening necessarily as fast as everybody expected it to. You know, you've got bang out numbers from big tech, for example. They've been leading the rally, but does that really mean that the health of the whole economy is strong?
Look, you're right, Jack. It's fits and starts. Again, when I talk about earnings in general, of course, the big techs have kind of helped out quite a bit. Yeah, this is a very difficult environment because we really have the haves and have-nots. The have-nots are clearly, cruise companies, airline companies, travel, leisure, hotel chains, restaurant chains. I mean, unfortunately, those are still lagging and will continue to lag until we get through the rollout, until we start seeing the infection rate really get down to where it can get back to business, so to speak. And it really is the haves and have-nots, to your point, Jackie. And the haves definitely been technology. The stay-at-home economy, the remote economy has really given a lot more demand towards cloud and AI and robotics and all these areas that were growing quite a bit fast before the pandemic, but now even accelerated more because of this stay-at-home economy that we're in.
Yeah, and Wall Street is also watching Capitol Hill and, of course, the next round of COVID-19 relief. The markets have pointed higher ahead of the expected $1.9 trillion bill. They definitely are pricing it in. Ken, how do you think that's going to impact the economy? What's your prediction for what happens after that? Usually people, they're pricing it in, they get excited about it, then what?
Well, again, it feels like a sugar high, right? So I think this is kind of a two-act play, so a Broadway play, a little plot twist in there somewhere. The first act is the kind of the sugar high, the stimulus, people going to Home Depots and Walmarts and Best Buy and use that money, hopefully not buying GameStop with that money. and then the second act, unfortunately, may be the other side of it, how we pay for this. Higher income taxes, capital gains taxes, corporate taxes, more regulations. And the second act, I don't think investors are going to like that too much. But yeah, that's a bearish right now. Again, we can't look too far ahead, but look what's in front of us. The moving averages, as you said, we're setting records and so forth. But again, we got to stay away from looking too far down the road. But certainly down the road, we're going to have to pay for this in some way.
We are. And another issue that the Fed is going to have to deal with is going to be inflation. John Hilsenrath, there's a big debate about whether, we're going to see that inflation come to the market. The Fed will tell you that they've got it all under control. And other people will say, well, we keep putting injecting so much money into the economy. It's impossible not to see that happen.
Yeah, when I think about inflation, you have to think about prices in different respects, right? So there's consumer prices. That's how the Fed defines inflation, what's happening to the price of dry cleaning or picking up groceries. But then you look at asset prices, and I think that if we're going, and what we've seen over the last couple of decades is when we've gotten price pressure, it's been in asset prices and not consumer prices. So I think that's where you potentially get some problems down the road. We're seeing an asset price boom right now. The Fed says they're not too worried about it. But if the economy is going to get destabilized, it's going to be there. Real estate prices, stock prices, some other realm like that.
All right. I'm going to thank Ken Mahoney. And, of course, my panel is going to stick around. Gentlemen, great conversation. But I do want to get to the more